On to the ET Money Show, we make sure that we just don't talk about investing in mutual funds, but also help you meet the brain behind these funds. And in this week's Your Fund Manager segment, we have on board Sumit Shukla, who is the MD and CEO of Axis Pension Fund. Let's understand what exactly this fund is and how it is performing, especially given the fact that it is a recently listed fund, listed back in 2022. And should you invest in this particular fund? Let's answer all these questions with Sumit Shukla. Sumit, welcome to the ET Money Show, and thank you so much for joining us today on ET Now. Firstly, when it comes to the pension fund, we would like to know your understanding and your advice to all of viewers out there that why should they really look at the pension fund, why it is actually beneficial for them, and also at what age they should start planning for their retirement, and in order to reap the benefits, what is the ideal age as per you to start for this?
So thanks to ET Now and you for giving me this opportunity to come and talk about pension and retirement overall. So as they say in savings, and particularly saving for retirement, you have to start very early. The earlier that you start, you will have that much of an happy retirement or the larger amount of pension you will get. So as one starts working, ideal is that they should start contributing some money to the national pension scheme and save for the retirement. Because ironically, what happens is you work for everybody joins work at about 25 years of age and works till 60. So that is about 35 years of working. But post 60, you have to live for another 30 years because people are not going to die so fast that you have to take care of your retirement needs when you're not going to have a steady income. So that is very important, that you should start saving early and keep on contributing to build your pension corpus, which is large enough. And National Pension Scheme is the vehicle which is a product of the Government of India, and it is tailor-made for people who want to save for retirement. It is the safest place to save for retirement at this point of time. And one has to realize that the NPS as a product is used by particularly by government employees. It's mandatory for state and central government employees. So the government has created a product which is used by its own employees, which is a large base of employees. So it has to be one of the safest from a risk angle and from a return angle also. So one has to start early and save as much as possible. But needless to say, if you have not saved and you are already reached 35, 40, you should look at a decent amount of sum. And there are calculators which are there on our website and other pension funds website. One can calculate and see as to how much corpus a person needs and what is the pension that they will need. But one has to start quickly. One has to start through National Pension Scheme, and that's the best vehicle to save for your retirement.
Talking about your pension fund specifically in this particular space, you guys are a bit new in terms of getting this fund. Back in October 2022, you got this, and now as I know that your AUM is 223 crores. So tell us about how do you plan the investments, because we know that there are mandates with respect to the from the government itself, like you were just mentioning, that it is a product that is being designed by the government, that you have restriction in terms of investing, in terms of the large cap, how you are investing in debt and equity bifurcation. But for your fund, how do you guys plan it, and what is the basic feel or the basic vision in terms of the returns that you wish to give to all your investors? And also tell us in terms of the AUM from 223 crores, what is the next target that you guys have for you?
So basically, the entire product is regulated by a regulator, which is Pension Fund Regulatory Development Authority, PFRD, which is a separate regulator. Particularly, investments are regulated by NPS Trust, which is a centralized body which looks after all the investments that happen. Very important from a subscriber perspective, because somebody has to keep a close watch on how this money is getting invested. And that is where PFRD and NPS Trust are doing a very good job in making sure that investments are in the right place and money is protected from a customer perspective. If you look at where do we do our investments, we have 4 schemes. E is the equity scheme. We are only allowed to invest in top 200 companies in India. That makes us largely a large cap oriented fund. But we are only allowed top 200 companies according to the market cap. And that too, there is a quite a diligent exercise that we do to choose out of those 200 stocks to invest in equity. On the corporate and the government debt side, particularly in the corporate debt side, nothing less than AAA rated is put in the debt, and it is everything is made sure that it is the best in class from a risk angle, from a investment angle, that the debt is also put in. So whether it is corporate debt or government debt, it is completely safe. And then we have the alternative investment fund, where the subscriber can put money, where we put investments into REITs and InvITs to make sure. Now, the philosophy behind a pension fund or a retirement planning is, from a pension fund manager perspective, is that we have to look at the long term. Particularly when a person is investing in a pension fund, we can predict as to when he's going to retire, and we can actually look at it at a portfolio from an aging perspective and take a call on investment, whether in equity or government debt or corporate debt, from a long-term perspective, and invest in those assets which are going to yield returns in the long term. And that is the reason why what you will see is our returns are superior to a mutual fund or a life insurance, because we hold it for longer term, and we are, we can pass through many cycles before a stock or a debt has to go through. So from a perspective, it is long term. Investment in solid companies, making sure that when the person is retiring, there is no shock waiting for him. As he retires, he should be having an happy retirement. And that from that perspective, it is very important that you look at all the risk angles and making sure that the ratings and everything, or how the financials are, and you're choosing the right stock, and it is getting continuously overviewed. It is reviewed regularly, quarterly by our boards, respected board of our companies. Plus the NPS Trust, plus the PFRDA, they all review the portfolio and give suggestions and advice into what changes it has to be done. So from a subscriber perspective, they have to be rest assured that their money is at the right place, a long-term view is taken, and the investments are done accordingly. If you see internationally also, and we keep on reading articles where we see Canadian pension fund and Norwegian pension funds are buying assets in India. So largely pension funds worldwide also are looking at long-term assets to create wealth for their subscribers, and same is true for India also. That is where the idea is of making an investment in these things. Particularly for Axis Pension, our aim is to be best in class on the investment side, to provide superior returns, making sure Axis as a group is a one-stop shop from a retirement perspective. Anybody who walks into a branch as a customer gets the right advice on retirement, becomes our customer, and we handhold him till the time his investment is managed by us. And after his retirement, how his money is going to be invested, how is it going to be taken care of. So end to end, everything is within the Axis Group family now. We are also the trustee bank. Axis Bank is the only trustee bank within the NPS architecture. So we are creating a one-stop shop of retirement within Axis, and that shows our sharp focus on customer segments. So we have created it as a separate segment, and we look at retirement or retirement planning as a segment which we are attacking from all sides and trying to build a big business. Vis-a-vis numbers, we want to be about 50,000 crores in 5 years. That's the target we have set ourselves. The first target is to be by FY28, 50,000 crores of AUM. And that's what the agenda is that we are driving now.
Okay, thank you so much, Sumit, for putting in perspective that how do you guys plan the investments, what are the regulations, and what is the target on AUM. But since this pension fund investing is a long-term investing, is like you highlighted, but since the start of your fund back in October 2022, the journey has been in terms of NAV, if you can just highlight this for our viewers, and going ahead, what is your expectation, because most of your exposure is in the large cap space. So going ahead, what outlook do you hold with respect to the performance of the large cap names, especially for 2023?
So as we got into this business in October 22, we took a conscious call of going into a passive strategy because our portfolio was quite small. So for the first 4, 5, 6 months, we were in a passive strategy, looking at only top 50 stocks, and that is where our investments were. As we have grown in size post 1st of January, we have started picking up equity opportunities outside of the top 50 stocks, and we have now a universe of about 80 stocks where we are investing, and we keep on increasing that universe. As we build our portfolio, we are making sure that our equity universe keeps on increasing and our debt universe also keeps on increasing. We have a solid team of investment led by a tenured CIO. And the idea is we invest money, and as an Axis Group, we want to put money on our investment team, from research, from fund manager to the CIO, so that we have the best brains working behind in getting the right customer, the right investment. And that is where the agenda is being driven today. As I look at returns, particularly from an investment point of view, if you look at retirement or pension funds, one has to look at returns in the long term. And as I said, we are into assets, and our ideology is to look at the long-term investment cycle, because we can predict there is no pressure of redemption which comes from a pension fund perspective, because we know people have invested at 35 age, 40 age, and I can predict when they're going to take out the money. So from a long-term perspective, one has to look at returns, and all our fund managers are giving very good returns, and we are all, some of the funds have been there in existence for a long time. But all of them are doing a very good job, and on an overall basis, whether it's equity or debt, the fund performance is superior. And same is going to be true for Axis. We want to be in the top quartile, make sure that our risk is taken care of. We put the right money at the right places and give superior returns. So we track it against mutual fund and other industries also. But important from a subscriber perspective, one should look at the long term whenever you are comparing for a pension return. Short term is not what one should look at. And in the long term, I can assure you superior returns will be delivered for the kind of investment philosophy we all are driving, and particularly in Axis, what we are trying to achieve.
Absolutely, Sumit. But whenever somebody is looking for investments in the mutual funds, one other area that they are concerned about is the expense ratio. Tell us, or help us understand rather, how is the expense ratio difference between the traditional mutual fund and the pension mutual fund? Because your pension mutual fund is very well regulated in terms of the investments, as well as there is a limit onto the expense ratio that can be charged. So tell us, what is the comparison looking like, and also at Axis Mutual Fund, any average number that you can tell our viewers that this much is the expense ratio? If you can shed some light over here.
So basically, what happens is in pension fund, it's a very good question. People don't look at cost, but if you look at the pension fund charges that we levy to the customer, and which you can call it as a TER in the mutual fund space. So I would not like to comment on what it is in the mutual fund space, but I will talk about the pension funds. So our total expense ratio as a fund manager, it starts with 9 basis points and goes down to 5 basis points. If you compare it with any other mutual fund or life insurance, this will be 1/20th or 1/30th of what they charge. So if you put your money 100 rupees here, 99.9 rupees will be getting invested. Only 10 basis points at an average would be 5 basis point to 10 basis point is going to get deducted. So that really impacts the portfolio in the long term. As I said, that if you have to look at the long term investment in a pension fund, and this deduction in the TER happens out of your AUM. So the money that you gets out of your entire AUM is very, very small. And as you look at the long term and you start looking at your portfolio, you will see the value of lesser TER in pension fund impacting your portfolio than a higher TER. So on a blended basis, this is not going to be more than 5 to 6 basis point, whatever cost. And if you look at it, why government created this vehicle of NPS? It was basically to provide a low cost vehicle for people to save for their retirement. The ideology was to go low cost. They had a disintegrated structure. And that's the structure that they have come out with. So we are a fund manager. Our entire sales process runs through POPs, which are called the point of presence. And so when you open an NPS account, you are charged 400 rupees. Plus you have to pay 0.5 on the contribution, not on the AUM, for your money that gets invested. And when I manage your fund as a pension fund manager, I manage it between 5 basis points to 9 basis points. So in totality, the charges are very low. Even to manage your account or your change of address or anything that you want to do with your account, the charges are minimal. So a product which is, I think, if you look at an OECD study with the OECD studies all the financial products across the world, it was rated as the most cost-effective product in the world, and I think it continues to hold that space that it is the most cost-effective product in the world. at the same time, what happens is the fallout is, since we don't make that large amount of money as pension fund managers, the subscriber or the customers benefit from it, but we don't get the monies to spend on marketing or doing sales in the way that other people are able to do. So the pitfall is that it's a great product for the customer. It is not such a great product for the distributor because they don't make that much money, or for the manufacturer in that case. But considering that for the subscriber or the customer, it's a no-brainer that everybody in India should have a NPS account. If you have not opened it, please open it. It's an online seamless journey that you can open it in 5 minutes, 10 minutes. You can go to our website on Axis Pension Fund, or you can go to the Axis Bank website, open your account and start saving today. You will laugh away. But I have customers who have been with us for so many years. I only get happy messages from them whenever they see their corpus, how it has grown. So come on to it, enjoy the benefits. The tax benefits are also very superior. The tax benefits, even in the new tax regime, the tax benefit of a salaried customer is there. So end to end, everything is available in the product. Please open an account and start saving for your retirement.
Okay, that's an interesting point you highlighted, and some of the pain points for the industry as well, why you guys don't go big onto the promotion side. But Sumit, like you were mentioning that the expense ratio is very low, so definitely it's a very good for the consumers in terms of compounding their wealth over the years. The multiplier effect could be really amazing. But tell us, what is the minimum amount that they can start with this NPS scheme? And you were also mentioning that the process is really simple. So somebody looking at the show right now, help him understand that how he can actually go and start this NPS scheme. What is the process looking like? How simple it is, and onto the tax benefit, how they can be benefited due to this.
The entire process of buying is completely digital. If you have an Aadhaar, you have to just through the Aadhaar, you can open an account in 10 minutes. It is a unique account. It is like a unique account, like you have a PAN number. You will get a permanent retirement account number. That account number is valid to you throughout your life. So once you open an account, put your Aadhaar number, and you will have to choose where you want to put your money. Options are equity, corporate debt, government debt, and alternative fund. You decide your fund manager. Once you decide your fund manager and your fund, that the account will get opened. You can do systematic investment plan. You can do a lump sum. You can do whatever way you want to invest. Money will keep on accumulating in your PRAN number or your account, and you will keep on getting alerts from the CRA or the person, the people who are managing the back end. You will continue to get serviced by them. Completely digital from an account. Once the account gets opened, you get a PRAN kit. You will have access to your online account. You can look at your account. You can manage your account completely. You can do that. So that is there. From a tax benefit perspective, if you are working in any company or a corporate, 10% of your basic salary is completely tax-free under a separate section, not covered under ATC. So you have to talk to your HR. Make sure you open your NPS account, send your HR the account number. They will deduct 10% of your basic salary and contribute to your NPS account. And every month, like your PF deduction, your NPS deduction will continue to go to your account number and will keep on accumulating. If you change jobs, the corporate here will stop. The corporate way you're joining will continue to contribute. Even you stop working and you want to continue with the account will continue to be there. The investment will continue to be there. At the same time, there is a separate 50,000 rupee tax benefit, which is under Section 80C, which is over and above 1.5 lakhs, which a customer can avail and take that benefit. So basically 10% of your basic plus 50,000 rupees is completely tax-free that you can put in your account. You can do it. You can start your account with 500 rupees, 1,000 rupees, and then start contribution. There is no limitation that you have to start with 10,000 rupees, 20,000 rupees. You can start with 1,000 rupees and your account is established. You can go to your bank account. Each and every bank today has a facility where you can pay your NPS payment through your bank account. You can link it and at the same time put frequency in your SI, systematic investment, and the money can keep on accumulating in your NPS account. So once you get onto it, particularly for the Gen X, the apps or the applications that are there with the CRA, which is KFintech and NSDL, is outstanding. You can see your investment there on the app. you and at the same time manage your investment and completely be safe. It's not like EPFO. You are not it's not that it's not accessible. Very easy to access. You don't have to be worried about anything,
Sure.
and completely transparent.
Okay, okay. Thank you so much for simplifying the whole process, Sumit. With this, we'll let you go on that. And thank you so much for joining us today on ET Now and helping all our viewers, helping them to meet their fund manager as well as helping them understand that what NPS means and how they can actually go ahead investing in this particular scheme. But with this, viewers, it's time to slip into a short break onto the Money Show right now. But don't go anywhere. A very interesting discussion onto the ideal holding period of your mutual fund. We'll be carrying the discussion ahead with another guest, Mr. Feroz Aziz of Anand Rathi, will be joining us shortly. Stay tuned. Welcome back to the ET Money Show. On to the second segment, we're going to be discussing about the holding period for your mutual funds. Equity mutual funds are long-term investments, and equity mutual fund SIPs typically create wealth over a long term. That is still an extremely open-ended statement. What does long-term mean? Does it mean 5 years, 10 years, or 20 years? Also, what are the red flags in a portfolio that an investor must keep an eye on? Let's answer all these questions with Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management and Anand Rathi Financial Services. Thank you so much, Feroz, and thank you so much for joining us today on ET Now. Very good evening to you. That's a very interesting topic indeed, because what we see or what we get to listen generally is that invest in mutual funds and stay invested for the long term. But when I talk about all these Gen Zs and millennials, they have that anxiety either to get their money out after having a handsome profit, or when the money is doing nothing, the return is really stagnant, they have that anxiety to take that money out or rather invest in some stocks or some other asset classes like cryptos maybe, who can give them better returns. So on to the mutual fund investing. Advise the viewers that what is the ideal amount or the ideal time that where they should stay invested.
Hi, Shrishti. Good evening. I completely concur that this is a very interesting topic. What's long term? Because short term and long term are English words. If you can actually transform them into mathematical guiding principles, it becomes relatively simpler for a lay investor. Point one, I think we have to bifurcate this question into two parts. Now, of course, one size doesn't fit all. Having said which, there are several factors which will decide the period. It could be the financial goals, it could be the risk tolerance, it could be the investment horizon, market conditions. Several things actually influence a holding period or ideal holding period, and it's not one size fits all. The personal in the statement personal finance is the individuality of the current status of a specific investment. Having said which, one thing as a matter of principle, everybody should try and incorporate, if that makes sense to the viewer. In my opinion, that's the most important fundamental principle when you're doing investing, is equity needs very long. There's a difference between the time frame of long term for equity and the scheme. Now, for example, I would want to give equity 20 years to invest, but not every scheme, equity mutual fund scheme, 20 years. What am I trying to make a point is that over the last 9.5 years, we have been running a model portfolio. We have bought 38 schemes, sold 37 schemes in the model portfolio, and beaten Nifty by 3.23. If I just bought the same schemes which I bought 9.5 years back and didn't make any changes, every 10 crore investor of ours would have been poorer by 2.5 crores. So point I'm trying to make is give equity, which is the asset class long term, need not necessarily give the same benefit to each scheme. Schemes require a complete, thorough, zero-based evaluation every 2 years, and equity needs eternity as an investing time frame. So long term is forever till you need the money, and minimum is 8 to 10 years.
Okay, minimum time is 8 to 10 years. But Feroz, when it comes to taxation, guide us. For a viewer, what does this mean? Because in terms of the taxation, there are two factors at play. Firstly, short-term tax, and the other one is long-term tax. And in that as well, there's a difference between equity as well as debt investing. So whenever anybody who is wishing to stay invested for long-term, how will taxation make a difference there?
Rishi, I'd like to take a minute in terms of drawing up the context, because I think taxation is one of the most important things an investor needs to comprehend. And not just today's taxation, the envisaged taxation 2 years from now, 5 years from now. What would taxation look like? See, it's because tax rules are of not the investment date. When you redeem, is whatever the applicable tax rules will be applicable on your money. You may think that you're going to pay 10% tax on equity. If the law changes and you are having to pay 15%, you will have to pay 15%. So it's not just important to understand the current taxation, also understand what is the ministry thinking. And every government gives you clear signs of where is it headed. What am I trying to say is India is looking at tax regimes becoming simple on every count. Income tax is becoming simple. There's a second method which has very, very clean, no exemptions. Corporate tax has been simplified. Capital gain tax is still waiting to be simplified, and it is funnily complex. Which is a long-term asset, becomes long-term in 12 months. Debt, which is from an investor standpoint, money you keep for short terms, becomes long-term in 3 years. And real estate becomes long-term in 2 years. It's just the opposite of how it should be. So I think capital gain tax will be simplified in the country. And I think like other top five global economies, they have very, very simple tax. All asset classes have the same taxation in most of the economies above us in terms of size. Now coming to what's the taxation in the current regime is more than 12 years, equity mutual funds become long-term, or any equity asset class which is listed becomes long-term in 12 months. Unlisted equity becomes long-term in 2 years. Debt funds, which is a more retail instrument, becomes long-term in 3 years, provided they have 1/3 in equity. 1/3 in equity is a new rule which happened when the finance bill became an act on 26th of March this year. Debt funds now don't become long-term at all if they are purchased after 1st of April 2023. This huge change in taxation of debt mutual funds still needs to be sunken, and every investor who's putting money in debt now has to believe in the new rules and pay taxes as per the new rules. So debt funds will never become long-term, even after a 10-year holding period. That's the Section 50AA inclusion, which I'm referring to in this finance bill, which became an act in the parliament lately.
Okay, Feroz, thank you so much for that understanding, and I really like the term that you used for LTCG, and I hope that as per your wish, the government takes steps in that direction. But whenever somebody is investing in mutual funds, Feroz, people are advised that they should have a goal before they step into this investing world. So tell us, as per the investor's goal, how should they decide rather for their investment horizon, in view their investment goals? How should they try to get these lines in a parallel direction?
Yes, Srishti, I think goals are very important. In any step of life, you will have goals, right? Why should there be no goals in something as critical as money, right? When you're actually going from point A to point B, you use Google Map, right? Would it give you any directions if you don't put the destination which you choose to achieve? So without a goal, if Google Map is useless, is it not? And there are several such analogies which I can draw up in every walk of life. We use some degree of objectives, which is what we wish to achieve. So in money, it's very important to put a goal. If you put a goal, you know whether you're going at the right pace to reach at the right time. That's point one. Point two, if you put a goal, discipline is a byproduct of goals. If you know you're saving for your child's education, then don't you think your commitment to making that monthly installment becomes that much more, because you have internalized that this is money kept aside for my son or daughter's education. What more important in life could it be than giving good education to your next generation? So goals bring in discipline. Goals bring in clarity, whether you're on the path at the right pace. That's two. Now that you have goals, how does transform those goals into actions? And when you invest, you need actions emanating from your goal. So what would I do is, let's assume I have 5 goals, one of them as short as 3 years, another 5 years, another which could be 10, or the last one could be 30 years. I will try and find out what is the weighted average life of all my goals. If I need 5 crores after 30 years, if I need 3 crores after 10 years, a crore after 3 years, I will try and find out, if I put all these goals into one bucket, what is the life of all my goals as a weighted average? Let's assume that is 9 years. That the total goals, if you weight and average it, it comes 9 years. That implies that the asset allocation, which I have the flexibility to follow, is going to be 60 to 70% in equity. If the weighted average goals life comes to 4 years, then I know I can't go more than 30% in equity, 40% in equity. So that's where the asset allocation strategy can be derived out of the weighted average life of all my goals put together.
Feroz, when it comes to investing, at the very start, what I was referring to, that whenever the return is actually not that significant, then people have that anxiety. Whenever they have good gains, they generally wish to book that and rather invest in some other asset class. But whenever they're at loss, they stick to investing. They just hope for a recovery in terms of their portfolio can bounce back, or rather they can just take out their money when it is at no profit, no loss situation. So for all those viewers, as per your experience, tell us what red flags they should actually be looking at, and at what point in time they should really try to take out their money to help our viewers have an understanding on this.
Yes, Srishti, see, you're absolutely right. This is exactly what happens in the practical world. When there are profits, people want to book the profits and go into something which can be at a higher pace. There is a set of people like that. There is another set of people, when they see negative, they redeem lock, stock, barrel and lose all hope. Either way, you're not right. Point is that investing is both a game of heart and the mind. If you don't bring in a balance between these two, irrational actions are going to happen. You're going to be chasing your own tail. Now coming to the action of what one should do, if equities are down, be rest assured that you don't have to worry. Look at math, and math will give you the confidence to carry on. Now, markets every year have fallen 14.3% every single year for the last 22 years as an average. And if you remove those 2 years, which is the exaggerated years of the global financial crisis and the COVID, usko chhod ke, we have an average fall of 15% every single year. And still investors are surprised when the market falls. I was just speaking to an investor yesterday. He says, market kyun giri thi? Right? How does it matter? It falls every time. You have to decide what you have to do. So point is, please always have hope that markets have fallen every year. And today we are sitting at almost the peak levels. So it doesn't go down unilaterally, becoming zero. Stop believing that. Even if COVID could recover, when almost all of them were sitting at home, all of us were sitting at home, and if it can overcome such an adversity and still come back 76% the subsequent year after FY20, why would you believe that it is only one way down? So don't ever remove equity on the lower side. Now, on the higher side, you may want to choose to change your schemes, but don't leave equity as an asset class. If you're in India, by design, we are fortunate because you're in a country which is the fastest growing economy, because the rest of them have slowed down, right? And over the next 10 years, we will still remain one of the fastest growing economies. So it's good fortune. By chance, we live in a country which is the fastest growing economy. So why would you sell equity irrespective of the past performance being higher? This is what would be my suggestion to even the ultra HNIs of the people whom we interact with.
One red flag that investors should be concerned about is over concentration in a single category, or rather AMC. Tell us more on this one, your thoughts with this particular, so that they don't put all their eggs in one basket. How should they decide in terms of the bifurcation of their portfolio? Your thoughts on the same?
Yes, you're absolutely right. What happens is people concentrate on larger monies in one scheme, or a lot of schemes of the same AMC, or a lot of schemes of the same category. So this concentration could be a 3-leg concentration. Don't concentrate your money beyond 7, 8, 10% in one scheme. This is mathematically provable that you don't need to put 25% of your money in one scheme. Second, unless you just have 2,000 rupees to invest and you're putting it in 2 schemes, so you have 50% in one, you have 50%. I'm speaking about a reasonable investor who's invested for 3-4 years, invest 10,000 rupees in SIP, try and keep 8 schemes, which makes it 12% per scheme. That's one. Second, don't be under the habit of going to your bank and the same banker recommending you their own mutual funds, 5 schemes. This is something which is very prevalent that if you see that a guy is dealing with one private sector bank, all the schemes of the same mutual fund of the sister company become a part of the book. Thirdly, there are 8 very good categories which SEBI carved out in 2018. Don't put all your money into flexi caps, 4 flexi caps. That's a wrong strategy. You try and identify which are the categories and have one scheme each. So because each fund manager is different, each category's banat is different, the objective is different. So these are the 3 legs of concentration which you would like to be conscious and in turn avoid.
Well, thank you so much, Feroz, for helping us understand or helping our viewers understand what should be the ideal investment horizon for your mutual fund schemes. With this, it's time to slip into a short break, but Feroz, stay tuned, because as we come right back, we will have you to help our viewers with their portfolio related queries, and we'll try to help them on that front. But with this, viewers, it's time to slip into a short break, but don't go anywhere. We'll be right back. Welcome back to the Money Show on ET Now, and now it is the time to help resolving all your portfolio related queries. And there are a plethora of funds that are available in the market to invest your hard-earned money in, but how should you assess which is the right fund for your portfolio, and what are the criteria that one should look at? To help you navigate through this maze, we have on board Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management. And also, do not forget to send us your portfolio queries on our WhatsApp number, that is 865-797-4571, or you can also email us your queries onto the moneyshow@etnow.tv. But with this, let's quickly kickstart taking all your stock related, all your portfolio related queries. And onto this particular segment, we try to connect live with our viewers. So onto the phone line, we have Prashant, and Feroz, Prashant has a portfolio query. He will share his portfolio with you. Prashant, a very good evening to you. Please go on.
Good evening, ma'am. Good evening, sir. So, as I have stated in my message, that I have basically 4 funds in my portfolio right now, and that is I have one index fund which is a UTI Nifty 50 index fund. Then I have 2 flexi caps funds. One is Parak Parak and the other one is Quant. The reason why I have 2 flexi caps is because when I compared their both their existing holdings, I found that there's very less commonality between both of them, and hence there are 2 flexi cap funds. I thought that would provide me a diversity. Then finally, I have one small cap fund, which is Nippon India. So basically, my goal at the end of this is I want to generate a corpus at around 1.5 crores, and the tenure that I'm looking for is either 15 years or 20 years. And that I would like to know how to go about that, whether 15 is better or 20 is better from the expert. So yeah, that's it. And I have a few more questions down the line. Maybe I'll ask to the experts during the discussion.
Well, yes, I can see that you have plethora of questions for us, but let me take it the first question, in that in terms of the goal that you have set in. Feroz, in total, he invests around 10,000 of rupees in SIPs, and you already have the names of the SIPs. He wants to achieve a corpus of 1.5 CRs in the next 10 to 15 years. So particular investment, do you feel that they are good enough to reap this much amount in the next decade or so?
I think if you look at the investment amount needed, if you work backward, Prashant, if you want to get to 1.5 crore, if you assume a 14% rate of growth, which is a reasonable assumption, because I think median returns of Nifty are about 11%. These actively managed funds, other than the one which you have, which is the UTI 50 index, Nifty 50 index, will not generate alpha. Of course, the rest of them would ideally expect it to be generating alpha. So that will give you 13-14%. If we use that as the expected rate of return, as we discussed, the fair number, so you will still need a 25,000 rupees per month to be able to accumulate this corpus in 15 years. So of course, if it's easier said than done, if you're doing 10,000 rupees, it was not surgically possible to move it to 25,000 the next day. So there is a step-up SIP as a concept where you try and move it up by about 12-15% every year. I think that should quench the thirst of achieving this 1.5 crore target if you can actually scale up your SIPs on a 12 to 15% year on year, which as your disposable incomes go up with your salaries. That's point one. Point two, your schemes are four, but I'm reasonably impressed with the fact that you are trying to dig deep and understand what the internal constituents of the mutual fund are. Quite a few investors don't even know their names of the fund sometimes, not the fund manager, let alone getting into the each individual constituents to see if there's an intersection between the schemes. It's great to be curious about the money you deploy because it's hard-earned money. It's not coming free. A lot of hard work goes into earning money. So that's a very impressive thing, and I think every viewer should take inspiration from that. Now coming to the schemes which you have, I would definitely request you to add the number of schemes. We concluded a study which of about 300 portfolios in the laboratory to find out whether 4 schemes are good enough. Our conclusion was that even if you have 10,000 rupees, and 8-9 schemes could be statistically provable again. So I think you have headroom to add more schemes. If I were you, the next point I'm trying to make is if I were you, I would never invest in an index fund because there are 380 active funds. Not all of them are good, not all of them are bad, but concluding that nobody can beat Nifty on the large cap side may not be a fair assumption because several do. And so making a choice, looking at the money show, if you make some choice, it's quite likely the unbiased advice which comes your way can beat that index fund. So that's the tip 3. So I can give you some schemes which can be material for consideration to add to the list of 4 which you have. 2 of them I would exit, which is Parag Parikh FlexiCap and UTI Nifty 50 Index Fund. HDFC FlexiCap, Kotak Emerging, ICICI Focused Equity, Aditya Birla Sun Life, Small Cap Fund, SBI Contra, Franklin India Blue Chip, Kotak Multi-Cap, and ICICI Dividend Yield Fund. That's 8 schemes, 8 plus 2 minus 2. So that brings you back to 8.
That's a long list given by Feroz where you can look out for options. I hope this solves your query, Prashant. But moving on to the next caller that we have online is Jayanti with us. Jayanti, please go on and ask your question.
Yeah, my question is about buying digital gold by companies like Tanishq. Is it a better way of investing than physical gold? Due to safety reasons, what is the cost effect?
And very interesting and intriguing because a lot of these females, I'm surprised to see that they go and take all these schemes related to gold investing rather than buy gold. So help her understand that what is the advantages of investing in digital gold rather than buying the gold in a physical format, and what are the advantages keeping the long-term investment horizon in view.
Yes, I think, Jayanti, your question is valid, but it's as a matter of investing principle. That's what I've learned after a couple of decades of experience, and I'm meeting a few thousand ultra HNIs and HNIs, that you don't take any risk for no reward. All right. So even if there's a gun on my head, I would not be buying digital gold from a corporate. Nothing against Tanishq. They're a great company, I'm sure, Tata backed and stuff. It's a listed company. But unless you're getting 3-4% more than a sovereign gold bond, why would I actually go and lend money to a corporate? Because it's not just the gold's risk, it's the solvency risk as well in whatever shape and form. Not completely though. So a complete no-no. Here you have sovereign gold bond, which is committing to you to give you 2.5% extra every year and also give you tax-free gains. Sovereign gold bonds don't have any capital gain if held till maturity. If you're making 10%, you're saving 2% more of tax every year. So that's like a 3.5 to 4.5% gift every single year. This is like an absolute free lunch, almost equal to the savings bank account. With this alternative, if there is another corporate who says that I'll not give you this 3-4% and take more risk, I'll give you less return, how does it make any mathematical sense to trust money with a corporate?
Okay, so that's the advice coming in for Jayanti, but let's quickly move on to a third caller that we have, and Bimal is here onto the phone line. Hi, very good evening, Bimal. Please go on and ask your question to Feroz.
Yeah, good evening. I have 2 grandchildren, ages 14 and 12. So I have some funds, and I want to invest in a scheme where they can have a tax-free income when they are adults. So the investment amount is about 50 lakh each. So can you just suggest me the best scheme where I can invest the money and they can get some good return, tax-free?
Well, yes, absolutely. Feroz, you heard his question. He's looking to invest for his grandchildren. One is age 12 and the other one is 14. And it's almost half a crore that he's planning to invest for each of them. So looking out for the available tax-free return schemes and what he should get in his portfolio. So your advice.
Yes, Bimal sir, if you want to invest for your grandchildren, it's a superb thought. When it is invested for the grandchildren, it should be the risk appetite of the grandchildren. So I would suggest large portions of the money, if not all, in equity, because these kids may not need the money till they are 25, 27. Ideally, they should not touch this money, and this becomes their plan B in life rather than plan A. I'm sure you're also taking care of their education, or your son or daughter is taking care of your grandchildren's education. So you're putting a great value system, you're putting an education. This is their plan B. So the risk appetite and the returns risk and strategy has to be of the children, not you. That's point one. Point two, I think tax as a principle should not be the primary decider or even an influencer when it comes to investing. Why am I saying that? Is I might today buy a tax-free bond and can earn me 6% yield till maturity. It is absolutely tax-free. But if I get an equity fund which is 14% but has 10% tax or 11% tax including cess and surcharge, 11.96 to be precise, I'm still 12% or 11.5%, significantly better than 6. So I would say, since it's children, large portions in equity, you will not get tax-free income in equity mutual fund. You will have to pay 11.96% tax, including the surcharge and cess, depending on the slab you are in. But I think you should get into equities, and if they have 10 years time frames, unless you have this money to be pulled out for their education at the age of their being 20 or 19 or 18, then of course equity is not the right vehicle. But if that's not the case, and if this is just a plan B for the children, then I think equity is the way to go. There are several schemes which we believe are futuristically good to perform, are flashing on your screen. I can read them out to you. But I think you should diversify across all these 10, 11 schemes which you are seeing. The ICICI approved focused equity, HDFC Flexi Cap, HDFC Small Cap, SBI Large and Mid Cap, Quant Active, ICICI approved Dividend Deal, Franklin India Blue Chip, Canara Robeco Flexi Cap, and Aditya Birla Small Cap.
Okay, so that's a long list, Mr. Bimal, that Feroz has got for you. Wish you take the whole advantage of that, and wishing you all the best for the investment for your grandchildren. And with this, it's time to wrap this edition. So Feroz, we'll let you go on that. Thank you so much for joining us today on ET Now and helping all of you with their portfolio related queries, as well as guiding them how long they should stay invested in their mutual fund portfolio. But with this, viewers, it's a goodbye from me and the entire team who put the show together. Thank you so much for watching.
पानी से भरी बाल्टी जो जल्दी ऊपर लाएगा वही